Thank you so much for coming. My name is Jonathan Greenblatt. I am the director of the Impact Economy Initiative here at the Aspen Institute, and we are just delighted to welcome a standing room crowd here at 1 DuPont Circle tonight. We've got a really exciting program, and we want to be respectful of people's time, so we're going to get started. Without further ado, I'd like to introduce the Vice President of the Aspen Institute and the Director of the Philanthropy and Social Innovation Program, Jane Wales, to make some introductory remarks.
Thanks. And welcome. We're just so delighted you're here. As you know, Jonathan has just begun this program in the last few months, and so we're extremely pleased to be hosting it at Aspen with the support, not only financial, but also moral and intellectual support of the Rockefeller Foundation. So we felt very, very fortunate. And of course, as you know, the Rockefeller Foundation was both the funding and the intellectual partner behind the report that you'll be hearing about tonight. I just want to call out a few people who are here, speaking of the Rockefeller Foundation. Margot, Brandenburg, and Justine Malai, and of course they've been real leaders in this space along with their colleague Anthony Buglevine. I'd also like to introduce Beth Cyril, President of the Pacific Community Ventures. And that's a community development fund out in California. It focuses on job creation in California in particular. And they are co-authors of this report. Their Insight division is co-author of this report along with Harvard's Institute for Responsible Investing. And we've got to introduce David Wood, who's the co-author of the report. This is a really far-sighted report. It's a really smart investment of people's time and finances. And we're sort of struck by the timing, what good timing this release is showing, coming out shortly before the State of the Union message, just as the administration is focusing like a laser on the question of how do you have job creation be very much at the center of growth. We also hope that this will help inform the summit at State that's being anticipated that will shine a spotlight on social enterprise around the world, and that's something we at Aspen are particularly interested in. I noticed there are some members of Aspen Network of Development Enterprises here, so welcome to you. This is the first public program of the Impact Economy strand of our work at Aspen. So Jonathan, I'm going to turn it over to you.
Great. Thank you very much, Jane. And again, as Jane said, we're really delighted to see all of you here this evening, and particularly excited not only by the involvement of the Institute for Responsible Investing and Pacific Community Ventures. We'll hear from Ben Thornley and David Wood, the authors of the report, in just a moment. We're also very grateful for the support of the Rockefeller Foundation. As Jane mentioned, the Rockefeller Foundation has really been instrumental in growing this field of impact investing. And Margot Brandenburg, who helps to lead that work, is here tonight. And actually, before you start with the program, I may ask you, Margot, to make a couple comments about where the policy and research dimension of your work is going. I also want to acknowledge Amit Buri is here from the GIN, the Global Impact Investing Network. Amit, thank you for coming down from New York. So before we get started, I'd like to just make a couple remarks about why we're all here tonight and what is impact investing. It's a term that's beginning to gain a great deal of currency, certainly in the investing world in New York and in other capitals, but interestingly here in Washington, D.C., which we think is a really very exciting development. We consider impact investing as investments that aim to solve social and environmental challenges while generating financial return. Sometimes that can be from returning principal capital to market rate returns, to even those returns that beat market beating rates. And sometimes we might think of these as positive screen investments. And I noticed that Wayne Silby, one of the founders of Calvert Fund, is here somewhere in the room. Calvert, we're going to hear from Lisa Hall from the Calvert Foundation later. What's interesting, whereas Calvert helped to define the field of socially responsible investing many years ago, which is funny because Wayne is only 30, 35 years old. Impact investing is about positive screen investments that in a proactive way generate the right kind of returns. The Impact Economy Initiative here at the Aspen Institute is designed to think about how do we create an enabling environment to support both impact investing, the supply side, as well as social enterprises, the demand side of this emerging field. How can we use policy and programs? How can we determine the appropriate role of government where we can help to grow and support this, again, this nascent but important part of the economy? As Jane mentioned, this is the first public program. we'll be undertaking a series of convenings much like this, working in partnership with the other programs here at the Aspen Institute, as well as I hope with many of you. So as we get this work underway, we would be delighted to explore ways we might collaborate. In addition, we'll be conducting research, syndicating our ideas, and really, we hope, developing recommendations that are substantive and can support the executive and the legislative branch as they seek to build out this new area of policy. So I'm grateful for all of you being here, and we'll be delighted to talk at further length about our program. But let's focus tonight on this report and on the work of the Rockefeller Foundation. So in fact, before I introduce you, Ben and David, Margot, could you just for a quick moment tell us a little bit about the Rockefeller Foundation's program to support impact investing?
I'd be happy to. I don't even think I need to come to the microphone unless someone tells me they can't hear me, and I will spare you all repeated mentions of the Rockefeller Foundation. You've probably all heard our elevator pitch delivered most likely with greater rhetorical flourish from my colleague Anthony Buckley. So I will not go into it, although I would be happy to brief anyone over cocktails if you haven't by chance heard it. But maybe two things. Oh, I'm sorry. Two things, one by way of context and a second by way of invitation really to anyone here. The first being the context, when our board of directors authorized the launch of an initiative called Harnessing the Power of Impact Investing. It had three components attached to it. One was on promoting industry leadership, which we've done by being really proud supporters of the GIN and of Andy, now of the new Impact Economy Initiative, different emerging associations to steward the development of the industry. The second was on helping develop industry infrastructure, rating systems, reporting standards, social stock exchanges, a variety of initiatives. And the third was on helping catalyze vehicles that can really help intermediate capital in newer sectors and at greater scale. And so the initiative had those three prongs, and we were sort of merrily going down along our path, but realized very quickly that we had underattended to the critical role that research and policy play in creating an enabling environment for impact investing. And we knew anecdotally, whether it's the Community Reinvestment Act in the US or the Green Fund Scheme in the Netherlands, that where you see really robust areas of activity, that's generally had at least one policy catalyst. So we were really fortunate to be able to support and work with IRI and Insight and now the Aspen Institute, both to unearth the myriad policies that exist around the world that we didn't even know we didn't know, and also to situate them in a framework that could be the starting point of a conversation. And so that's why we're here today. But looking forward, we really hope that this framework is just the beginning of that conversation. And we invite everyone to sort of describe whether or not it resonates with them, to push back on it, and more importantly, to hopefully surface opportunities for deeper dive policy and research in 2011 and 2012. So we have sort of a two-pager, an invitation to folks who are interested in pursuing this in a particular country or sectoral context. We've got some resources, we've got some convening plans, and so we would really love for this to be a conversation that grows in the next 1 to 2 years. So that's about all I'll say. We will stick around afterward if anyone wants to take up the call. But thank you again to Jane and to Jonathan and to everyone else.
Great, thank you very much, Margot. So what I'd like to do is we're fortunate tonight to be joined by a very distinguished panel. Before we do that, maybe David and Ben, you could set the stage by walking us through your work. Let me give you this.
Do you need us to use a...
There's a mic right underneath. You could just hit unmute. Excuse me.
All right. Can everyone hear me okay? So hi everyone, and thanks for joining us. Thank you, Jane, for having us at the Aspen Institute. We're delighted to be launching the report here and look forward to working, Jonathan, with you and the Impact Economy program in the next year. Before we get into the research, I did want to just quickly call out and re-acknowledge a few people myself. Beth at Pacific Community Ventures for her leadership, and Margot and Justina have not only been supporters but also collaborators and really have provided feedback to us on ideas and have really brought all the knowledge they have from from building the field nationally and internationally to this project, so we're grateful for that. And also wanted to acknowledge our two other co-authors who are here as well, Katie Grace from the Initiative for Responsible Investment, and Sarah Sullivan from Inside is also with us. So, so the genesis of our work was really the point that's been made that policy is really central to some of the most robust financial markets that we consider to be part of the impact investing world. And that's not a surprise, because if a government believes that private capital can bring explicit and intentional social or environmental benefit, it's likely that the government has an interest in building or sustaining that market. Now, I say if the government has an interest, because it's important to place our research in context. We've really wanted to bring the lens of policymakers to this field of impact investing. And policymakers typically start from a point of market failure and externalities and internalities, or intentionally trying to achieve some social objective through policy. And in some cases, there's a role for the private sector in doing that. And in some cases, frankly, there's not a role for private capital. And in fact, private capital may even be inappropriate in some situations. So we really begin our research from the perspective that the government has established that a role for private capital is consistent with its objectives, or at the very least that that's a prospect that they are considering. And here are some examples of some of the markets that we've seen, and you know, the report includes 16 case studies where we talk more about these examples. The report includes some discussion of that overarching role of government, and that would differ depending on the issue area we're talking about, or the country, or the political environment, or the existing infrastructure in a particular place. We also wanted to examine what was out there, the range of policies that are available, and then ultimately, after throwing a lot of policies up against the wall, what we were trying to do was draw out the common characteristics that suggested to us whether a policy was more or less likely to succeed in its objective, which is bringing private capital to bear on social and environmental problems. So these are the three parts of the report we ended up with. A framework illustrating the role of government in impact investing markets, 16 case studies, and then a set of analytical criteria. And David is going to take us through some of those things.
In 3 minutes, I'm going to describe what's in the report. And I know, so I'll just offer a teaser, and you'll go home tonight and read it, and send along your questions, tomorrow, and we'll do it online learning. So, is this on? Yes. It is. You're good. My voice isn't booming the way I hoped for it to. So we started this project sort of stupidly. We decided, well, there's no field of impact investing in policy. It hasn't been developed yet. We're reading backwards into policies that weren't designed to do this. So let's grab every global policy that intentionally or unintentionally creates an impact investing market and see what we come up with. And we did that for a couple months, and we sort of read around in different literatures on tax reform and read around different literatures on land use regulation, and we gathered all these policies together and drove ourselves into a ditch and kind of went crazy. And then we went off and had a drink and came back and said, what we need to do is figure out a way to talk about these policies, and the project became then a framework, and you'll hear the word framework a lot, to figure out what we're trying to describe as we talk. And we did this with a lot of help from a lot of people in the room, by the way. I mean, I'm not going to call everyone who, we had a meeting in June at Harvard that was just hugely helpful, because we got people out in the field to tell us, how to think. And we needed that. But so what we decided was we need a framework to think about what are policies trying to do and how are they trying to solve a particular problem. And I want to reemphasize the point that Ben made. We're not looking at big structural issues, not sort of financial reform issues about how to make markets work properly. We're looking at targeted policy, and that's super important. And if you want to talk afterwards about that, I will talk. But we're looking at targeted policies that specifically bring capital to bear to solve a particular problem. And we came up with this, which we used to call the football, because there were no gaps of white between those. But the design had expanded out. It's now sort of an oddball hexagon. And it breaks the market out into 3 pieces, and you try to place a policy where it is meant to intervene in order to solve a problem. So you have the supply development of capital being brought to bear, new capital brought to bear on a problem. You have policies that direct capital, and supply development can be anything from co-investment directly, from governments, or from rules and requirements that direct new capital into markets. And then you have policies that direct capital, taxation, or carbon tax would be something that pushes capital in the right direction. But you also might have public procurement policies of the sort that Ted Howard, who told us a lot about the Evergreen Initiative in Cleveland, describes. And then you have policies that create demand. And this can happen either through the enabling of corporate structures. If you think of B corporations, this is a demand creation, an investable product that then investors can put money into that creates a certain social good. But you can also just have capacity building. And so just to illustrate, very quickly, one of the things that I've been trying to think a lot about is the Sustainable Communities Initiative, the HUD, DOT, EPA, joint initiative to try to create the kind of things that equitable, smart growth development. You might need policies in supply that bring in public pension funds, changes safe harbor laws for ERISA that allow pension funds to look at different kinds of investments that they're not familiar with or that might not always pass muster in more conventional arrangements. There might be capital direction policies, and this is land use regulations that promote mixed use development. Or you might have demand development, and here to try to create these kinds of mixed income, mixed use projects, there's a whole lot of brain damage that comes from stitching together the different kinds of funding. And maybe there's a policy role just to reduce the transaction costs through the purveyance of information. What we hope this framework does is help policymakers, advocates, investors who are involved in these discussions think about what they're trying to achieve with a specific policy against that question of, how do we end up with an equitable, trans-oriented development, but also to think about where the most effective intervention might be. Do you need all three at the same time? Does it turn out that ERISA isn't really a constraint on pension funds, but it's the fact that there aren't scaled investments that they can invest in? If you think through, with the football, that might be a way to enable a discussion. And that's kind of where we see this report having gotten us so far. Good. And then we have 16 case studies in the back, and you'll read them tonight, but it's, they go into some detail about how they particularly intervene. We drew out of those case studies this sort of set of 6 they're commonplaces. There's nothing particularly special about them, but they jumped out at us as we read through each case that there were specific issues that came up as a way to tell whether this directed policy was actually going to be effective or not. You might be looking at whether the policy actually targets, is narrowly targeted, like the low-income. We had a great presentation last night in New York from Aaron Powers of Bank of America, and he was talking about why LIHTC worked, why the low-income housing tax really focused on what you were trying to achieve, and why some things don't, and why new markets maybe didn't, focus as well. But you also need to have transparency, and this is about, are you getting the goals that you're trying to achieve? You need to coordinate with all the other policies out there in the environment. This isn't, you can't just remake the world with one, piece. You need to engage with investors up front to make sure that you are answering their needs, but also that you are not feeding their desires. That you're working with what the market needs, but not giving away free money. That's another, it may be that all of this could be fixed by the Fed printing lots of money, but that's not the kind of policy we're talking about. And then just real quickly, to give you 2 case studies to give you a sort of sense of them. This is where they are around the world. We scatter around. We look for global policies, really to look for a range of types of policies. Types of interventions and geographic diversity. There was no science in how we picked the 16, and we think there's a lot more work to do to sort of systemically think through what cases are. One of them was a Peruvian policy that opened up pension fund investing in small and medium-sized enterprises. And the idea was there was this missing middle in the market. I have lots of people from India here. We can talk about the missing middle. And that large institutional investors couldn't get into the missing middle for regulatory reasons. But in the event, it turns out that maybe there weren't enough investable products, or it wasn't really the regulatory issue with the pension funds that was keeping them out. And also, it was targeting SMEs generally, which did not necessarily lead to socially optimal SMEs. And so the market wasn't being directed towards this generation of social good. And then we talk about the Netherlands Green Fund scheme, which is a tax incentive to sort of bring capital towards environmentally friendly projects in the Netherlands. If you talk to Triodos Bank, who's one of the big actors in sort of creating them and also in enacting them, they say what it was really successful at is creating an investor base that cared about green products. It sort of created this retail base where you now have a market for green products. And so it was very successful, not necessarily for what it was trying to do, which was bring tons of new capital into the green space. It did some of that too, but in that it sort of legitimized the idea. But on the other hand, there's the problem of commitment. You know, markets need certainty, and I mean, I sort of, some of this uncertainty nonsense is nonsense, but a lot of it's true. You know, you have to know what's going to happen 1, 5, and 10 years down the road. And there's a new government in the Netherlands. Everyone's talking about fiscal austerity. Can they make these commitments to this sort of incentive-style policy that is meant to, you know, last? If they go away, like there's a lot of the subsidies in the U.S., you know, this every annual year, you know, every annual re-upping of solar credits creates a real problem for keeping capital flowing. So that quickly, certainly more than 3 minutes, but lots of words for the number of minutes I used, gives you a sense of what's in the report, and we'd love to talk to you about it. We'd love to hear about any conversations you're having around it, but also to sort of take these really high-level, sort of simple ideas and put them to work on actual policies.
Yeah, just quickly to reiterate what David said, and Margot's already stated that we're continuing with the research. I mean, there's a few parts to that. There's our own research we're continuing. We're supporting others doing research in other places around the world. And our contact information is on the inside front cover of the report. So please feel free to get in touch, and we look forward to working, Jonathan, with you and Amit with Jen and others as we move forward. So thanks very much.
Great. Thank you. Thank you very much, Ben. So now we're going to move to the panel portion of our evening's program. And as I mentioned before, we are really fortunate to have 3 very distinguished individuals with us. I'll ask all of you if you wouldn't mind coming up to the front. All of you should have seen on your chairs information sheets with bios for each of the panelists. They're far too accomplished for me to be able to effectively summarize their achievements. But I will take the liberty of introducing each of them before they make their comments. And what we tried to do this evening was to bring together both folks who are on the government side, thinking about impact investing related policies in a domestic and an international context, as well as someone with government experience who's now a private investor, who's thinking about both the domestic and international dimensions of the impact economy. So as they get settled, I'll note that after they make their remarks, we'll have an open Q&A. So those who have questions or things that you want to ask of the 3 panelists up here, as well as of Ben or David, it'll be your opportunity to do so afterwards. All right, so why don't we get started, and I'm going to ask the Honorable Sonal Shah to make the opening remarks. Sonal is I know she's ready for that, so we know that. She is the founding director of the new Office of Social Innovation and Civic Participation at the White House. Sonal comes to that role having come from the private sector, where she was both at Google and prior to that at Goldman Sachs. And previous to her work in the business community, she actually served at the National Security Council and at the Treasury Department in the first part of her career. She's an economist by training, so it makes her particularly appropriate for tonight's remarks. Sonal.
Well, thank you for inviting us. And thanks. It's great to see everybody here. In fact, I should thank both of you for putting out for this report, because it's very helpful to have a framework in which to think about impact investing. I think we've talked about it in multiple ways, in different ways, but to have this framework and really to look at this is helpful for the government, to be fair, and we'll be cribbing from it very easily. What you can't do in the outside world, we can do on the inside. But also to the community in general on pushing for impact investing, because I think we talk about this quite a bit, and I know I've been in multiple conversations for years about this, but to have this conversation come to where we're actually talking about policy and how policy can work with impact investing just goes to show that it's come a long way, and that there's actually a conversation that can take place about policy angles on this. And thanks to the Aspen Institute for actually hosting this and really putting this on the agenda, and for all of your work in helping us actually also in thinking this through. So we've been thinking about impact investing for a variety of reasons. Comes at it from 2 different angles. One from the business side, just thinking about where we're going over the next few years, which is jobs, 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 and the economy. And we are not going to be, if anything, what we will be hearing over the next year, or certainly the next few weeks, is going to be all about jobs and the economy. And this is such an important part of how we decide to grow. Is going to be an important part of what we set the stage for, and why I think the impact investing piece comes into as an important part from the domestic perspective is really thinking about the types of businesses we want to grow and the type of economy we want to start developing, and setting that right incentive process is important for us to think about. It's certainly one of the things that's going to become important over the next year. And as budgets get tighter, it's going to be even more important on thinking about what private sector can do and how we can incent the private sector in different ways to think about this. So those are kind of two big things that are going to be coming and that we need to keep in mind. What we've been doing internally is just really bringing all of the agencies that work on impact or potentially work on impact investing across the government to start talking about this as an agenda item. So we've got the international agencies, which include USAID, state, and OPIC, and we've got domestic agencies, NEC, SBA, Treasury, who also are thinking about this, and to really think about what's an agenda we can think about as a government. And certainly, the framework you had is certainly the framework we've been using, which is helpful. The bigger challenge for us, and as we think through this, is how do we narrow that even more? Do we think about it as people? Do we think about it as places? Do we think about it as issues? But what do we take this framework to, and how do we apply it somewhere? Do we apply it in agriculture? Do we apply it in low-income neighborhoods? Do we encounter to low-income to individuals? How do we think about this framework? And that, I think, as we start beginning the process internally for us, that's going to be a very important conversation. The second piece, which I know that on the international side you all have done a lot with in GIN, and I know you're looking at this more broadly, is metrics. How do we actually measure whether it's an impact or it's not an impact? If somebody were creating a job, is that an impact or is that not an impact? And those are the tough questions in government that we have to parse through, while from a broad policy perspective, it's easy to talk about. When it actually comes to how do we actually apply it, and how do we actually go and report to Congress whether we actually did it, we have to think through kind of all the details of that. And those are, I think, important questions that we're going to be looking forward to having that conversation with as we move forward. And then finally, thinking about what types of investment structures should the government be thinking about. Now, interestingly, and I know Elizabeth's going to talk about OPIC, there's a lot more on the international side to think about incenting structures. On the domestic side, there's not that much. So to really think about what the domestic investment structures might look like, other than an investment fund, but are there other policies we should be looking at? Those are things that we're beginning to have the conversations internally to think about which agencies, who do we partner with, how do we think about it. And it comes to tax structures, thinking about broad tax reform, and then thinking about how this fits into it, because what we don't want is yet another tax policy that just adds to the confusion, but really thinking about tax policy in a more consistent way. So as these conversations start moving forward, this is going to be some of the work that we'll be doing across the board in the government, at least from a federal perspective.
Wonderful. Thank you very much, Sonal. Now it's a pleasure to introduce the Honorable Elizabeth Littlefield, who is the CEO and President of OPIC. But interestingly, brings to that role literally a career of remarkable experience in the realm of microfinance. Elizabeth Littlefield ran the consultative group CGAP at the World Bank, and before that spent many years in the private sector at JP Morgan. Elizabeth, perhaps you can talk about impact investing in a more of the global context as Sonal laid it out.
Great. No, I'd love to. And thank you again, David and Ben, for a very useful report and a very useful framework. And of course to Jane and Jonathan for being here. I'm thrilled to know that you're here and running this initiative, and look forward to more work together with you. I say all that, but I have to admit, like up front, that not only did I come from JP Morgan, I spent sort of 20 years of my life deeply, deeply embedded in the extreme end of the private sector. And hailing as I do from that extreme kind of mercenary end, I still harbor a deep cautiousness about the role of government in pretty much anything. And you guys alluded in the report to why that is. I worry about blunt instruments. I worry about warped incentives. I worry about heavy hand. I worry about market forces. I worry about going against nature. I worry about all that stuff. Now, of course, that I'm working for the government, I harbor a more shallow, but nevertheless caution about the role of government in markets. And when I come to impact investing, I want to say it's all the more acute because for me, impact investing isn't just a market. It goes much deeper than that. This isn't about financial markets. This isn't about finally getting people to stop thinking with their charitable brain one half of the week and their financial, preservation of capital brain the other half of the week. This, to me, the whole impact investing movement is propelled by something very deep, very human, very social, and very human. It's about humanity. And when you look around the room, why is this taking such steam? It's taking steam because of the human need for connection, for hunger for meaning, a hunger for thinking globally, a hunger for brotherhood. I mean, I can get all kind of weepy about it, but it's really real. This is driving from a very deep place. And so therefore, I think we have to be all the more cautious about how we push it, how we nudge it, how we dangle carrots in front of it, and how we use sticks to move it forward. So I think that's not a very technical set of observations, but it's nevertheless a heartfelt one about how much I worry. And this is also coming on the back of having spent a decade helping to build the microfinance sector and seeing how many mistakes were made there when we pushed too hard, when we overpromised, when we had policies. Frankly, India, I know it's cited in your paper, there's kind of downsides too to that Indian priority sector lending policies. So I think that we have to look very carefully at how policies can twist things in unexpected directions. And I care a lot about this sector as I cared about microfinance. So I just want to make sure that we're doing what I think the report does do, which is be very careful about being targeted and being specific and having policies that are commensurate with the needs. So all that being said, I am now in the government and am seeking to design policies and intervene in ways that will help move the impact investing market forward. And so there is a clear role for me, and as Sonal said, we operate, of course, in the cross-border dimension of this impact investing world. And in so doing, I think there's two key roles that an organization such as OPIC can play. OPIC, for those of you that don't know, who really is the US government's development finance institution. You guys all know the IFC. We're kind of the IFC for the US, for those who don't know, when we do financing and guarantees and also political risk insurance. So thinking about what an organization like a development finance institution for the US can do in building a new market like this, I think there's many, but there's two key ones. One is demonstration effect, and there I think OPIC's played a very important role over the years in clearing the way and showing that a new market can really work. It did it, in the 70s, demonstrating that political risk insurance could work. It was the creator of that field, the inventor, if you will. And then later on, demonstrating that emerging markets private equity could work. So those are areas that OPIC got out in the front with the political capital of the U.S. behind it and showed that these two markets could work, and then the commercial markets came behind it and further developed them. And the second area is probably the most obvious one, and that is removing risk from the system or enhancing returns, and they're kind of the flip side of each other. And the way an organization such as OPIC and its brethren in other countries can do that is by doing things like getting into early stage things that no one else would do, taking longer maturities, taking risks that no one else will take, doing political risk insurance, for example, creating structures that really are very accommodating of strange new organizations that have particular needs. And those are the areas that we hope to focus on in terms of finding ways to take risk out of the system. I'm very cautious about using the word subsidy, though, in this regard, because we do take more risk. We will do longer maturities. We will go where no one else will go. In fact, we have to go where no one else will go, otherwise we're not allowed to do the business. But we're not subsidizing anything. We're just using the fact that we're a US government agency, which means that we're probably more likely to get paid back than somebody else might, to enable us to do things that other people won't. But in the end of the day, the most important thing to know about OPIC, particularly in this economic and political environment, is that we make money every single solitary year and contribute it back to the Treasury. So let's just keep remembering that. And I know I'm not allowed to say this, and my general counsel's in the front row, so I'll say it quickly, lest she not hear. If you meet your congressmen and representatives anywhere, just remember that OPIC makes money for the U.S. government. Is that okay? Can I say that? So what are we doing? What is OPIC doing in this impact investing space? Well, actually OPIC has been a classic impact investor, double bottom line investor, whatever you want to call it, for many, many, many years, insofar as no deal that OPIC will ever do in no matter what business line can be done unless it has A, a projected financial return, and B, a developmental return, social, environmental, whatever. And actually, we're a social first investor. We really are. We got to make money, but the investments we look for have to be developmental. So in many regards, it's been an impact investor for a long time. And in fact, I know we as an industry, impact investing industry, have had a long debate about definitions around what is impact investing, which seems to me something we've got to get sorted out pretty soon. But regardless of the definition, one can either say that 85% of our $15 billion portfolio is impact investing, which is kind of a big chunk, or maybe 30%. Either way, it's a big chunk when you look at a $15 billion portfolio. So what are we going to be doing going forward? In our role as the government agency, I think charged with pushing ahead on the impact investing field as it relates to cross-border work. The two biggest things I'll just say the one biggest thing we're doing right now will be, and I think many of you may know this, a call for funds where we're going to be soliciting proposals from qualified equity fund managers who are in the impact investing space. We're looking for everything from fund managers investing in SMEs, in water, in manufacturing, in agriculture, in microfinance, in microinsurance, anything that is the broad range of things that's been mapped out as the impact investing space. We'll be announcing that call for funds somewhere probably the end of February to close it probably the end of April or May. And we're looking to, we're ready to put, $200-300 million into the space. But we don't want to flood it because we don't want to push too hard if it's not ready. So it's going to be a very interesting game of figuring out what are the right investments. We don't want to be supporting things that are going to fail ultimately. But we're ready to put as much capital as can be absorbed to help move the space forward. And we're extremely excited about working with many of you in this space, either in a fund-to-fund capacity or directly or advising us. But together we want to make sure that we as a government agency really directly in this impact investing space in emerging markets, that we're getting the guidance from all of you and doing all that we can to make sure that we're supporting, shaping, helping to create and propel the space without pushing it over the brink. Thank you.
Great. Thank you, Elizabeth. And lastly, I'm delighted to welcome Lisa Hall as our third and final panelist. Lisa is the recently named president and CEO of the Calvert Foundation, which is a role to which she brings a wealth of experience, both also being an alumni of J.P. Morgan, and after that, spending time in public service at the U.S. Department of Treasury. So, Lisa, it's great to have your perspective, someone who comes from government, can speak to the private investor role.
Yeah. Thank you, Jonathan. And I'd like to echo the thanks that Sonal and Elizabeth offered to David and Ben as the authors of the report, and to Jane and Jonathan for hosting us here, and of course to Rockefeller for his generous support of all the work that is emerging in the field of impact investing. So I'm with Calvert Foundation, and I see a lot of our key stakeholders, our partners, our supporters in the room, so I don't think I have to spend a lot of time describing what we do. But we have been working hard for 15 years to really connect investors with worthy causes. And we do that in a number of ways, through raising capital from individuals. We have over 7,000 investors now, some of which are actually in the room. I saw some of our investors here that provide capital to be invested into the impact investing marketplace. And when we were doing it 15 years ago, they didn't call it impact investing. We've popularized a term called community investing, but it all is captured in this sector. And we lend to CDFIs. We invest in microfinance institutions. We have a portfolio not quite as big as OPIC, of about 190 million now. And so I'm very excited to be here today to talk about the perspective of an investor who is actually making impact investments, and how public policy really does enable us to do our work. I also want to take a moment to emphasize the point that Elizabeth was making, because our 7,000 investors are making their investments in Calvert Foundation, which we then make into nonprofit organizations and social enterprises around the world. They're making those investments because of the social return that we provide. Calvert Foundation also provides a financial return of capital to investors, but really our value proposition is about the social good and the social return that's being generated by these investments. And I do think it's important that we not lose sight of the incredible need that is in the marketplace. And our jobs and the role of public policy is to create effective demand for capital and ways to drive capital to people and places that need it, that are currently underserved in the market by the traditional marketplace. So I wanted to spend a little bit of time talking about how Calvert Foundation as an investor has benefited from public policy measures. This includes the CDFI fund and the programs that are provided through the CDFI fund, including certification. And so the 50 CDFIs that we lend to benefit from a certification process that allows them to access capital from lots of different sources, including subsidy, to do their work. And that makes it possible for us to invest in those organizations and to get a return of our capital. It makes those organizations strong enough, credit-worthy enough that we can make loans to them and then get repaid. We also have benefited as investors from the existence of OPIC. And we're very pleased to invest in funds that have had structures with guarantees, some of the early microfinance funds where they guaranteed layers within the capital structure that made it possible for us to come in and be an investor. Similarly, we have benefited directly from a facility that enables us to invest in microfinance throughout the US in regions that we might not otherwise be comfortable taking credit risks, but because of our partnership with OPIC, we're able to do. And so that's been really important in enabling public policy for us. I also, in my 5 minutes, because I think we're only supposed to speak 5 minutes, wanted to talk about, well, what can the government be doing more of? And in addition to the framework and the examples that are cited in the report, there is a great value to coordinated activity and action. And I know there's a lot of work underway to make that happen. And I know in the room is my predecessor. I saw her, but I think she's, oh, there she is, Shari Berenbach, who is now with USAID and has joined the administration. And figuring out how the agencies coordinate across the administration is really critical. Because one of the challenges that investors have, that the organizations that we lend to, part of the challenge is figuring out how to manage these multiple agencies, multiple entities, multiple sources of funding. And so coordinated activity amongst the various agencies is, I think, a really critical part of thinking through the framework. I think the other piece that I want to emphasize around what more could the government be doing, I think really figuring out how to tap the power of the individual investment marketplace, which is what Calvert Foundation has been focused on for so many years, is raising capital from individuals. And there are lots of ways to do that through tax incentives, through guarantee programs. But we're at an inflection point right now in this space. And Wayne Silby and one of his colleagues, and Wayne, as Jonathan mentioned, is the founder of Calvert Foundation and also the Calvert Mutual Funds. They challenged me on this point. They said, we've been at this for 30 years. What makes now an inflection point? And there is a lot of talk about this inflection point and the tipping point. And I think we are seeing it in the mainstreaming and the popularization of impact investing. You're seeing it with JP Morgan Chase coming out with a research report through their equity department and about impact investing as an emerging asset class. You're seeing it with institutional investors, about as mainstream as you get in the trades for the financial industry, coming out with a cover story on ESG, or environmental social governance practices. So I do think we've reached a tipping point, and that one of the things that the government can be considering, in addition to the frameworks and examples that are cited in the report, is how do you provide incentives for individuals to invest in this space so that they can align their values with their money. And that it is about the brotherhood. It is about a new consciousness around capital and how capital is being used. And I think we have to leverage this moment in time. And Calvert Foundation is very excited to be at this intersection of social good and delivering sophisticated financial products and services. And I'm looking forward to the question and answer.
Wonderful. Thank you very much. So I'd like to sort of kick off the conversation and sort of draw upon an area where I know all of you have expertise, and you mentioned it, Elizabeth, in your comments, which is how do we balance between the role of government supporting a marketplace and being careful not to distort outcomes. And to that end, I'd like to talk briefly and get your thoughts on microfinance. This is a field which has gotten a lot of attention, both at an institutional and a retail level in recent years. It's been the subject of a dizzying array of press accounts, and yet for those of you following it, I'm guessing that pretty much everyone in this room is aware of some of the recent turbulence that we've seen in South Asia, particularly in India, around the field. And many of you probably saw Professor Eunice's piece in the New York Times just last week. So I'd like to start off with you, Elizabeth, and invite the other panelists to comment on what can we learn from the recent experience in microfinance about the role of the private sector, the role of government, and how we achieve the right balance between profits and purpose through policy. An easy one, Elizabeth.
Yeah.
I'll just maybe say a few things. First of all, I think there's been a lot of negative press. And, frankly, I remember when Mohammed Yunus got the Nobel Peace Prize, I could practically take a stopwatch and say, 10, 9, 8, 7, 6, until we knew that the backlash would start. It was completely predictable. And I think those of us that have been inveighing for years and years and years against the overpromising and the overhyping in this industry were even more trepidatious because we could see what was going to come. And I think that's true. And that's, I think, one clear message for this industry is, please let us not overpromise. Please let us not oversell, because it will absolutely get us in trouble, and it will get, more importantly, those that we seek to help in trouble too. So I think that, if I could say only one thing, I think it certainly would be that. And I guess the second thing I would say is I've been working in the microfinance field in one way or another since the mid-'80s. So I feel like I dedicated a big chunk of my life to this, but it's because having seen with my own eyes how the access to financial services, not credit so much as savings and the ability to transfer money from one part of the country to another, absolutely transforms people's lives. Not only do we know that it makes women have fewer children, nourish them better, put them in education for longer periods of time and through lean seasons, but it empowers women in a way that they're making more decisions for the family and for themselves that then has not an immediate effect on solving poverty. That's one way we overpromise. Microfinance does not solve poverty, at least in the first generation, at all. But the next generation, who have had more empowered mothers, better education, better nourishment, better food, and better housing, they go on to aspire for more, and I do believe they climb out of poverty generationally. That I will continue to defend the rest of the days of my life, and no amount of media press can convince me that it's not true. So I think we went too far in what we promised, and now the media is taking too far back. So that's all I would say.
Any other comments from other?
I think it's just important to remember that in anything, even with the impact investing sector, it's one part of the marketplace. And to put out there, and to just echo what Elizabeth said, to put out there that one is a solution to the development problem or one is a solution to the poverty problem in the United States would be the wrong thing to say. I think we just have to remember that it's one part of the marketplace, not the whole marketplace. And I think that's part of the overpromise piece of this. And The second piece I would say, even on microfinance, is policies in countries matter a lot. And there is a reason why Indian banks don't lend to low-income communities, and that is because the government steps in ways that it always has. And microfinance is now big enough to face the same set of issues that others have faced. And I think recognizing that there is a policy piece to this is important, and I think we've always known it, but we've always assumed that we could get beyond it. And at some point, policy and market come together, and it happens.
Great. So that actually is an interesting segue to a second question, which would be, you know, we're living in a very interesting time here, it seems like, in Washington, D.C., in terms of the political climate. We have new leadership in the House, as was mentioned by Jane. We have the State of the Union next week. This seems like an environment where it might be difficult for the administration because of the deficits in the current political atmosphere to introduce a lot of new ideas, to consider new legislation or even regulation. So how does impact investing, from a policy perspective, gain a foothold in an environment where people seem very trepidatious, to use the term, and very concerned about introducing new policies and new ideas? Is there an appetite for experimentation at this moment?
Yeah. So I would focus less on the experimentation piece and more on the doing good, because I think it is both in people's individual self-interest and that they can recognize that for us to have a sustainable environment. It's in people's self-interest for communities to be healthy. And I actually think we have an opportunity in front of us. You know, one of the references that I like to point to is that the New Markets Initiative, which is a program that has encouraged a lot of investment in the U.S. in low-income communities, was passed in 2000 when it was a bipartisan effort, when the Congress and the executive branch were held by different parties. And it's because this idea of doing good is appealing on many fronts. And I think rather than focus on the experimentation or people's unwillingness to test new ideas, is to really talk about what is old is new again. And this idea of philanthropy in its many forms, this idea of social return and having a social benefit of an investment in your community is appealing across many political fronts, I believe.
Yeah.
I guess I'd just say three things on that quickly. One is, I think it's been very, very powerful that the Secretary of State has so explicitly linked development and diplomacy as three cornerstones of our foreign policy with defense. I think that's incredibly powerful, and it works. It frankly works on both sides of the aisle, I've found. I think it's equally powerful that President Obama has, for the first time ever, had an explicit development policy articulated at the UN that talks about using all the different tools that we have at our disposal to move development forward, be it trade, be it investment, or be it foreign assistance. That's one point. Second point is, I do find myself talking a lot to different kinds of people that have very different perspectives and come from very different places than I personally do. And much as it sticks in my craw, I do find that with many, speaking to national interests is very powerful. It is in our country's national interest to ensure that hotspots where our troops are exposed, whether it be Afghanistan or Pakistan, or where we have a deep national interest like West Bank and Gaza, those countries need, those places need private sectors that are going to flourish and create jobs and create stability and hope and prosperity and all that. And that really appeals to, frankly, people that are quite conservative and wouldn't otherwise embrace the notion of us sending money abroad. And then the third thing I would say is, did I say earlier that OPIC makes money? Did I say that? No, I mean, one has to say we're not going to stop doing development at all. And so, we like to say if you can find a way to do development and make money for the government at the same time, that also I find is very compelling. So I do think that this administration, there's certainly ways to make a case for doing impact investing profitably with all dimensions of this administration.
Great. All right, why don't we open it up to questions from the audience. Before we do that, I want to use my moderator's prerogative to call out Shari Barenbach. Shari is the former CEO of Calvert Foundation, as Lisa mentioned, and now is a member of the administration serving at USAID. Shari.
Well, I was just going to hopefully launch off the first question.
Thank you.
And it's actually, although I'm currently now with USAID, obviously I was at Calvert Foundation for many years, where we were lending both, investing both domestically as well as internationally. And my question really harks more to the domestic picture. And that is, we really admire the work that OPIC does, and as an investor, focus internationally. And we don't really quite have the same sort of agency on the domestic side. And a couple of years ago, particularly as we were in the transition of government, we were floating around the idea of public-private partnerships, and really where you can begin to couple public resources to leverage private capital many times over, and really as a pool of capital to help seed venture funds here in the United States. I don't know if that idea is still knocking around, or if it's something that we really want to be putting back on the agenda. Just any thoughts or reactions from the panelists?
It's a marvelous idea.
And I should mention that idea really, Wayne Sylvie is here, and Wayne certainly was one of the proponents of this fund.
And I think that idea is still very much being discussed and on the table. The idea that public-private partnerships are a way to motivate private capital into this marketplace, and that, particularly after this economic period where risk-reward has been turned on its head a little bit, that investors are willing and interested to maybe get a little less upside if their downside is protected.
Right.
And that the government can play that role in helping to protect them from downside risk. And there are a number of proposals. There's an Enterprise Innovation Fund that has been discussed and bandied about, where it would be just that type of partnership, where there would be co-investment by the government and private capital that would match, and that the government would take a small amount of the early returns. They would go to the private investor, and then they would get the additional return later, so that if there weren't additional returns, that the government would really take that risk. But I also would point to, the original New Markets Tax Credit Initiative had an entity called the America's Private Investment Corporation proposal that was built into it, which was a similar concept about encouraging private investment in underserved communities in the United States. And so I think that there is a history of these types of ideas and figuring out which agency would manage that type of program, and where the dollars would come from in the budget are really important. But it's especially critical because equity is so important in the market. Not just the ability for investors to make equity investments, but the demand side of this, and the effect of demand is to be able to flow equity to some of these organizations, particularly in this environment where it's so hard to raise equity, is critical.
I think there's some interesting stuff to learn, and I agree with Lisa. And I think there's pieces that we should learn from of what's already been done, and not try to recreate the wheel. And what, as we learned in policy, is try it again, because next time, different environment, the same idea seems to work. And it's always worth thinking about whether it can be modified, or to think if it's the right environment in which to try these policies. Two things. One, equity is hard for the government because we don't actually score it very well, as Elizabeth knows. But I think it's worth thinking about how to come up with some sort of product that allows for it. But equity is a difficult process for the government, to, at least in the domestic and the international side, because of the way we score on budgets, to make that happen. So if there's different ways of thinking about that, that's something that's definitely worth. But public-private partnerships, absolutely, I think, is the right way to go. You don't really want the government to be the investor. You really need others who could invest in communities to be thinking about that. And then the second piece is, with the place-based policy initiatives that have been going on in the government, this is a real opportunity to think about how these venture funds might actually play within the place-based policies, and how we might use place-based policies most effectively to test is probably not the right word, but really figure out if there are structures that can be created in some of these communities, to think about how financial structures can be created for investment purposes. And I don't think we should dismiss the idea that we're moving more towards place-based anyway. that since we're moving in that direction, we should think about how we can create some financial structures in that direction.
Great, thank you, Sonal. Question over here. Can you tell us your name and where you're from?
Yeah, I'm John Nelson with Wall Street Without Walls, and very glad to be here with so many familiar faces who've been pushing this line for many, many years, and it's great to see it amplified here again. 2 points. One, coordination, and it would revolve around something Wall Street Without Walls did with the Calvert Foundation, which was we had 10 CDFIs that coordinated themselves, worked together to get a pre-development fund. You all provided Calvert Development Notes as the capital, and they suddenly had a $5 million fund for the 10 CDFIs to draw down on for from capital market sources, basically through your aggregation for pre-development hard-to-find dollars. So coordination is really critical to any kind of capital access activity, and I think we need to encourage that. The second has to do with policy, and those of you who know Greg Stample know that I might bring up the debt assets again. The whole idea of federal, state, and local governments all have access to assets that could be a credit enhancement to private sector investments. Blending of capital, whether it's from foundations doing investment-related investments, banks doing CRA-driven, blend is really critical. So the idea of having public assets as a credit enhancement, $10 billion going to the Federal Reserve, federal government every year, the U.S. government, and they're sold off at auction. They could be used as a credit enhancement. Cities own vacant lots and foreclosed properties. There's a lot of ways that this could be done at a municipal level as well to encourage and take the first loss position, and also provide equity capital to SMEs that are so hard to finance right now. So I'm encouraging both coordination and policies at the federal, state, and local level to leverage private sector investment.
That's an interesting idea, John. Any reactions from? Great. Let's reach one on the back. Over here, your name, please, and where you're from.
Yeah. Sujata Lahamba from the International Finance Corporation. Hi. I have two questions. One is to Elizabeth, and that's on, given your experience with CGAP, the Consultative Group for Assistance to the Poor and Microfinance, there are attempts today to emulate the CGAP framework for impact investing. Do you think this is necessary, and will it stimulate the impact investing industry? That's the first question. Second is to Lisa and Sonal Shah, maybe. On the private-public partnership, what are some of the sectors that you think that you could actually focus on in the US and internationally that will get you the impact you need? Thank you.
And what was the last part to get you the impact?
What are the sectors in particular where there
Right.
could be public-private partnerships?
Right. So at Calvert Foundation, we have taken a look at a lot of sectors recently as we think about how we might expand. One of the areas that we think has a lot of potential is the healthcare sector, with the growth that is going to be occurring with the recent legislation, assuming it doesn't get repealed, which I hope is a good assumption. And so we think the health sector, we think certainly environment, and there are a lot of streams within environment, both in the US and abroad. There are efforts around sustainable agriculture, which we think have very meaningful impacts and that could benefit from public-private partnerships. We think there are efforts around water and sanitation in the environment space. And so I could actually go on and on because we have spent a lot of time thinking through it. I also think we shouldn't ignore the existing sectors that continue to need capital in the impact investing space. Affordable housing remains a critical need. It's a huge social need in this country and abroad. And I think there are opportunities in microfinance housing that are worth exploring, where private capital could be very instrumental in developing countries. So there's a long list, and I think one of the points that I was making is that the need is endless, right? The tens of millions of people at the base of the pyramid, they are there, and they need capital to help address some of their needs. And so lots of sectors, and would love to talk to you more afterwards about some of the work that we've been doing exploring those sectors.
Elizabeth, can you tackle the first question about?
Yeah, I can just say a few things on. Well, I mean, certainly I think you'd be glad to know that we have. Where's that one my mic? But I think it's okay. We have been in close collaboration with of course, the Gin and with Andy, and both of whom have sort of sought out CGAP to sort of learn about the lessons that we learned and the mistakes that we made in CGAP in the early days. And I think in many ways the trajectory that impact investing will take is completely different from CGAP, but in many respects it's similar. On the one hand, microfinance is a lot simpler. It's easier. It was a more limited universe of folks, and narrower fields, and so in a way it was easier. But in many other ways, it's very similar. So, for example, some of the early tasks that we had in CGAP were things like creating a common language, a common set of, do we know what we're talking about when we say these words? And I think the Gin has spent a lot of time and had success in that realm. Then developing standards, which again the Gin and Andy have been both working on in their own separate ways. Sharing best practices, pointing to what works and what doesn't work. And then developing tools and measurement tools. We were very proud to have created the Mix, which Margot worked at many, many years ago, and other kinds of tools to measure, and track performance, which Gin has been very deeply involved with. Then getting beyond that, I think once credibility is established for independent thinking and high quality work, then I think you can, and I think that Gin and Andy will be doing this too, really start taking a stance on intellectually unpopular issues or things that are ahead of their time, and putting money at work in those areas, like CGAP did on mobile banking, for example, 8 years ago. So that is sort of the trajectory I see happening, where I think it will be very difficult, as it was for CGAP, and I think it still is and will always be for Andy and Gin and others, is tricky things that require putting people together and dealing with the mixed incentives. So finding mechanisms that really work for mutual accountability and holding one another accountable for results, that's really hard. Pooled investment vehicles that acknowledge differing incentives, that's really hard. So I think some things are going to be easy and some things will always be hard no matter what the organization is. But the question is welcome, and thank you.
Question in the back.
Hi, I'm Melissa Moy from the state of Maryland. Hello. Not speaking for the state, but I do invest the state's funds through the pension fund. I have a question in regard to commodity investing. There really is a huge wave of institutional money that's going into real investing, real assets now, and particularly driven by commodity, the trends in commodity prices, not the day-to-day fluctuations of gold, but rather the huge demand, for instance, for agricultural products. And we've talked a little bit about sustainable agriculture. I took a quick look through the book. There's not a lot there. And the question really is, beyond the demonstration effect of small investments in sustainable agriculture, when we think about particularly Africa, sub-Saharan Africa, Central and South America, where you're starting to see huge flows of institutional money into agricultural development for commodity production, where is the best work in terms of not just best practices, but real standards for agricultural development that is ready to meet this influx of investment? Thank you.
So, yeah, I'll take a stab at that and speak to an effort that Calvert Foundation is involved with, Transform Africa, which is actually being housed here at the Aspen Institute. It involves a policy piece as well as an investment piece. That Calvert Foundation is focused on the investment side of it. In that instance, we're very focused on small farmers or the smallholders, because a lot of the capital that you're describing is quite institutional in nature and is being driven to very large commercial agricultural operations. And it's not clear to us that that's the way to really meet the needs around poverty, because it's the smallholders and the small farmers that represent this huge percentage of the economic activity, but also really at the base of the pyramid in regions like Africa. And so the work that we're doing is looking at how do you invest in some of these smaller farms and how do you support the overall value chain. Because it's not just supporting the agriculture and the farmers, but also looking at the transportation infrastructure that they have available to them to get it to market. It's looking at production facilities to actually take agricultural products and turn them into goods that are, able to be exported. And so we are doing some work in that arena, and we think it's going to be very important to make sure that at the same time these big commercial efforts that are drawing a lot of private capital are coming into being, that there are also efforts to reach the smaller farmers, the smallholders, so that you're really reaching the base of the pyramid and having social or mission impact.
Great. I have time for 2 more questions. Amit, do you know?
Yeah, I just had a quick comment about the sustainable agriculture question. We actually have a group of our members who have taken a deep interest in sustainable agriculture in Africa in particular. So your question is quite opportune, and I think there's a real opportunity there because on the one hand, if there is the narrative of land grabs defining any investment in African agriculture, it'll dissuade a lot of investors who have good intentions or even just benign intentions from investing in the sector and starving a lot of people from an economic opportunity. And so we have a number of investors who are coming together both to help define the metrics for performance in sustainable agriculture, as well as thinking about principles about how you can think about more effective and sustainable practices to help guide many investors and help to articulate a path forward to make the practices more sustainable over time.
Thank you. Thank you. Probably time for one last question. I'm going to ask Cliff Kellogg, if you would.
Hi. Thank you for this very productive conversation. I have a question that bedevils us all, which is the definition of this sector, and whether we don't stand in peril of either under-defining this sector because we typically focus on low-income categories, or over-defining this sector. The cover article of HBR, Harvard Business Review this month, is a Michael Porter article that argues that creating shared wealth is the purpose of all companies, and there's something to that, but then it sort of takes away the meaning of this sector. So I think the definition of the sector becomes especially important when we talk about where to dedicate scarce governmental resources, especially. And I wonder whether the definition may not be either people, places, or issues, but rather viable projects, commercially viable projects that can't get financed. And we look for more definition of where the financial markets are failing, however, wherever that might occur, rather than these other categories. And I'd be interested in the panel's thoughts on the definition of this sector and whether that financing gap is another useful way to think about it in the context of government programs.
Anyone?
Cliff, I think you hit the nail on the head, which is the single greatest challenge of how do you define the sector. And we've talked about this quite a bit internally. Should we go, part of the reason we go to issue-based is, as you know, how does government funding work? So should we go to the Department of Education? Do we go to the Department of Agriculture? Where are the pots of money, and how might we define sectors based on issue-based for that reason, or priority-based if you think of the First Lady's initiative on healthy eating, and how do you get grocery stores into communities that don't have access to healthier foods. But I on the idea, so let me go to the one particular thing, on the idea of viable projects that can't get financed. So there's multiple definitions even within there. So do you go to the Valley of Death projects that got financing and they can't get the Series B or Series C financing? Do you go to, did they not get financing because they didn't work? Like, there's a whole series of challenges in that. And what we tend to find a lot is it gets us very quickly to the science space and the energy space, because that's really kind of where a lot of money has been dedicated already, whether it's green technologies or whether it's new technologies, biochem, other types of technologies that are out there. So we get very quickly to science, and we leave out a whole other sector of places. And so I think part of the reason that we've been in looking at place-based or in terms of sector-based is really trying to say, can we get to communities that might not otherwise get access to financing if left on their own, and which is why we got to CDFIs and why we ended up, why we did new markets tax credits. So I think that's a question that we probably all need to ask ourselves of what do we want to achieve and where do we want to achieve it in defining the sector. It may be slightly different internationally than domestically at the same time, because internationally it's a bigger space. Whereas I think domestically there's a lot that already takes place with SBA, there's a lot that takes place with Treasury, there's a lot that takes place with different agencies. And so we just need agriculture, there's all these different agencies that have different types of investment vehicles. So I don't know the answer to your question. I think we are thinking about this, and we could actually use some smart thinking on how do we define this space, and then should we test it in a few areas first and then broaden it, or do we try to do everything at the same time? And I think we're probably thinking more, on the domestic side at least, a few sectors first, and then thinking about how to broaden it.
Yeah, do we have time for me to take a stab at that
Sure,
as well?
sure.
Because I think in its broadest sense, a lot of people would say impact investing is about investments where there's both a social return and a financial return. And that could be a return of your capital, a return on your capital, but that you're getting financial and you're getting social. And that's in a very, very broad sense. But I think what we're talking about today is what part of the impact investing sector should government be enabling investment. And in my mind, that is where there are market failures, and that we have to be honest with ourselves that if the traditional marketplace was going to solve these problems on their own, they would be doing it, and they're not. And so it requires enabling environments, it requires incentives to draw the capital in to, in effect, create a subsidy. And I want to use that word carefully, because we so often think of it as public grant money when we talk about subsidy, but there are lots of ways to make up for the subsidy for what essentially is a public good that is being provided in a way, right? It's that it costs more to do it the right way. And the market hopefully will eventually catch up with doing it the right way, because it's in the collective self-interest. It's like, when did Body Shop go from being a social enterprise to just good business for L'Oreal? Right. Ben & Jerry's, right? This is owned by Unilever. So I think that the goal is for all of investing and all economic activity to be generating social return over time. But until we get there, there is a gap that needs to be met either through below market interest rate loans, which is what Calvert Foundation does, because investors are willing to take below market returns, or it needs to be done because there's a tax incentive. There needs to be some way to cover that gap. And I think that's what we're talking about today here, because impact investing is a very, very broad space right now. Not all of it needs government intervention.
I couldn't possibly say my opinions on this in the time we have left.
Okay. Well, so that's probably a fitting way to end this panel and to really close this evening. Let me make just a couple comments in closing. Number one, I want to thank our panelists for coming out this evening, and all of you for being here. I want to use my privilege to thank the staff at the Aspen Institute who made this possible: Eric Bohm, Tracy Totten, Tracy Rupnick, and Bob from the Aga Khan Foundation. And I think in closing, there is a lot more to be done. So if you find this interesting, if you want to get involved, please come find me, please come find Jane or any of the other folks who are here this evening. Thanks very much.